Good afternoon, everyone. We're just going to wait for folks to finish filing in. While that's happening, I'm just going to go over a couple of housekeeping rules. First of all, can you hear me? You can use the chat to indicate if you can hear me, or if you can't hear me. Great, okay. If any of the presenters are speaking too fast or too slowly, you can let us know through the chat function. The automated closed captioning feature is available for those who wish to use it. Participant mics will be muted throughout the webinar, and so we're going to ask, and the raise hand feature will be disabled. So we're just going to ask you to submit questions through the Q&A feature. We'll begin the session with opening remarks and then presentations from each of our panelists. After the presentations, we'll kick off the Q&A. So, as the presentations are happening, if you have questions that you want to submit, please submit them to the Q&A. I'll also note that this event will be recorded and posted on the NYC Create and Place Resource Hub, where you can view our previous programs. We'll be posting those links in the chat. And then finally, I just want to remind you that today's session is one in a three-part series. Last week, we had a session on organizational development and capacity building, and next week's session will be the last in this series. It's a virtual legal resource fair, and we will post the registration links in the chat as well. For now, it is my pleasure to introduce our panel. If we can bring them up and pull the slide down. Can you pull down the slide so that we can see our panel? Thank you. Today we have with us the Andrew Walrond from the Fund from the City of New York. The Fund for the City of New York advances innovation and provides lending to strengthen NYC nonprofits. Andrew Walrond is the Vice President of Loan Programs and leads nonprofit lending, which has overseen over 1.8 billion in loans. We also have from the Nonprofit Finance Fund, which is a CDFI providing financing and advisory services to nonprofits, Inez Marino Torres, who is Senior Director of Loan Origination. She leads lending strategy and is focused on equitable access to capital. Sea Change is also here, provides grants, loans, and advisory support to nonprofits. Minji Kim is Vice President and leads lending in New York City Arts Bridge funding initiatives. The Howard Gilman Foundation is also here, and they fund New York City performing arts through flexible long-term support. Anna Campbell, Program Officer, is an arts grantmaker with deep New York City cultural sector experience. Amalgamated Bank is our New York City-based union-owned bank focusing on social impact and sustainable finance. Clovis Thorn is a commercial banker there and supports nonprofits with banking, reserves, and credit, and he's a former nonprofit fundraising leader. The Department of Small Business Services, NYC Future Fund, supports small businesses with capital access and growth programs, and Karina Bucciarelli is the Director of Capital Access, who leads small business finance programs for New York City entrepreneurs. We will start with our first presentation from Fund for the City of New York. Andrew?
Great. Good afternoon, everyone. Thank you for being here. It's really great to be in a room with so many organizations doing important cultural work across the city. I'm pleased to introduce you to the Fund for the City of New York, and more specifically how our work supports organizations such as yours. Just a little backdrop. The fund was established in 1968 with a mission to improve the quality of life for all New Yorkers. For more than 6 decades, we've been working at the intersection of government and the nonprofit sector, helping organizations operate more effectively, innovate, and deliver services to communities across that city. One of the key ways we do this, which you're here to hear about, is through our nonprofit loan fund, which provides short-term, no-interest financing to help organizations manage timing gaps in funding. As Anne had said before, we have been doing this for quite some time, and we support hundreds of nonprofits each year through our various lending programs. Today, I want to focus on a program that is particularly relevant to this audience, the Cultural Arts Capital Fund. Um, and this program was specifically designed to aid small to mid-sized cultural arts organizations that are undertaking capital projects, whether that's renovations, equipment purchases, faculty, facility improvements tied to an approved capital grant. What makes this program especially valuable is that um, it provides access to capital when you need it most, before your grant funds are fully dispersed. As many of you know, capital funding can often be delayed due to administrative or reimbursement process. So our loan helps bridge that gap so that the project can keep moving without costly delays. Just as important, and our terms are intentionally nonprofit friendly, there is no interest, no origination fee, and only a one-time service fee. Um, um, this allows you to, preserve the resources while still accessing the funding needed to complete critical improvements to your organization's space and infrastructure. Um, in addition to the Capital Arts Capital Fund, I also want to mention a couple of other programs that can be really helpful, especially during the times when your operating budget might feel a bit tight while you're managing a capital project and need some extra financial flexibility. First, our cash flow loan program. This is our flagship program that was created in 1976. It provides bridge financing to our organizations awaiting committed funds from government or foundations, um, or sometimes tuition, depending on your organization. These are funds you've already been awarded but haven't yet received. Rather than slowing down programming or operation, this loan allows you to continue delivering services uninterrupted. Like our other programs, it's non-interest, which has a quick turnaround and carries only a minimal service fee of that 2%. We also have the Returnable Grant Fund. This is designed to organizations with New York City contracts, which provide advances against both registered and or delayed payment processing at no cost to you. In practical terms, this means that your city contract is delayed and processing or payment, we can step in to provide immediate cash flow assistance to your organizations without any disruption. So taken together, these programs designed to solve a common challenge across the nonprofit sector, which is timing. Funding is often committed, but not yet always received. When you need it, our role is to close that gap in any way that is affordable, efficient, and aligned with your mission. For cultural arts in particular, we understand that your work is not only operational, it's deeply tied to community, creativity, and place. So we want to ensure that your capital project can take place and will not be disrupted in any facet. And I'm happy to connect with you, with any of you after this and discuss your specific project or funding needs and how we might be of assistance to you. Thank you very much for your time.
Thank you so much, Andrew. And we will now go to our next presenter, Inez Marina Torres from the Nonprofit Finance Fund.
Thank you, Anne. Hi, everyone. I'm very excited to participate in this webinar. My name is Inez Marino Torres. I'm here representing a Nonprofit Finance Fund, or NFF. We are a national CDFI with over 45 years of expertise serving nonprofits across the country. We have 4 pillars to our work: financing, where I sit, consulting, community engagement, and advocacy. Next slide, please. I know we have limited time to present on our work and our organizations, but as long-term lenders and consultants to nonprofits at NFF, we always try to embed some technical assistance when looking at new loan requests, if we see the client may benefit from that. So I couldn't help but adding some TA to this presentation. As you can see on this slide, debt is really just one financial tool among many for nonprofits to realize their missions, but it definitely cannot replace other critical tools like revenue. Debt supports issues related to timing. So debt can be the right tool if you do not have the money needed for something, for a project today, but you know you will have that money in the future. Also, you need to ensure you have sufficient future revenue to cover normal operating costs and debt service payments. Next slide, please. The main takeaway from this slide is that securing financing for your capital project takes time. So working backwards from when you need the funds disbursed, you should start engaging lenders about 6 months before that desired closing date. Having said that, you also need to have a plan before you go to a lender because they will expect to see at least a project budget and what we call the sources and uses, which is a table showing what funding sources you are considering for the project and the status of securing each one of them. We encourage you always to talk to several lenders and to find the one that best fits your needs. So definitely shop around. Next slide, please. Here you can see the 4 ways you can pay for a capital project that can be applied independently. You can use only one, or you can combine a few of them. And the pros and cons and considerations for each one. So basically, you can use your own savings, which is adequate for smaller projects because it ties up your cash. You can also consider a capital campaign, but the downside, it ties up internal resources. You often need to resort to external consultants, and it may cannibalize your regular fundraising. We also have government funding and government programs, which sometimes require heavy reporting and tracking, so they may be time-consuming for your organization, and also disbursements may take months to happen, so that's something to consider. And finally, debt, which include acquisition loans, construction and renovation loans, and also bridge loans when the borrower has secured funding from a source that will pay in the future. Next slide, please. This is a summary of our basic loan products to finance capital projects. As you can see, we offer fixed rates in the low to mid 7%. With a 1.25% loan origination fee, and we don't have any prepayment penalties, which is particularly useful when considering bridge loans. I also wanted to know that NFF can be very flexible and creative when structuring loans. We can, for example, cover the financing need with 2 loans with different terms. One term loan to be repaid out of operating cash flow, and a bridge loan tied to a capital campaign or a grant, for example, to be repaid once the source grant is dispersed. We underwrite, approve, and close both loans at the same time for efficiency and to minimize closing fees. In terms of sizes, our loan sizes go from 250,000 to 8 million. But we often partner with other CDFIs to lend together when project budgets are higher. And next slide. This is just an example of a typical request that we receive connected to a capital project. In this case, the client is a dance school in New York City. They came to us because they needed to do renovations to their headquarters, which was a building owned free and clear by them, including renovations included replacement of windows and restoration of a glass-stained skylight. And they had secured a grant to cover a big chunk of the project. The name of the grant is the Community Resiliency, Economic Sustainability and Technology Program, or CREST. It's a state grant in the amount of $275,000. The total project cost was $350,000. So as I said, this was a straightforward bridge request with only one grant to be bridged. And we ended up structuring this bridge as a 12-month term with an option to extend for another 6 months, a balloon payment at the end once the CREST grant was dispersed, and interest only during the renovation period. This is it for me. I hope this was helpful, and I think I will now pass it back to Anne.
Thank you so much, Ines. Very helpful information here. Next up, I would like to welcome Minji Kim from Sea Change.
Thanks, Anne, and good afternoon. Thanks so much for having me. I'm Minji Kim from Sea Change. It's a pleasure to be in conversation with folks doing such important creative and community work. So today I'll spend a few minutes sharing who we are at Sea Change and how we think about capital project financing. Sea Change is a 501c3, a nonprofit founded in 2007 with the mission to help other nonprofits navigate what we call complex financial or organizational challenges. We do this by using 3 main tools. One, we make grants to 2 or more nonprofits that are either exploring or implementing long-term collaborations. This could be a merger, a programmatic joint venture, or shared back office functions. 2, and this is where I dedicate all my time on, is our lending program. We provide flexible impact-first loans to nonprofits in New York City, ranging from working capital and bridge financing to expansion and real estate-related loans. And finally, we offer light touch advisory/consulting support and a safe space for discussion. We've been making loans to nonprofits since 2013, including a number of loans to arts and culture nonprofits to support their acquisition or renovation projects. So we understand very closely that for arts groups, whether you're purchasing a space, renovating, or expanding, capital projects are transformative opportunities. But as you already know, they come with real challenges, and a common one being that your city or state funding that you secure for the capital projects often come in reimbursement-based grants. And this can create a short-term cash flow gap, even when your long-term funding for the project is secure. So that's typically where we come in to help you bridge that timing gap so your projects can move forward when they need to. And moving on to the next slide. So on a high level, our capital financing tends to look like this. Average loan size is around $500,000, although we can go higher or lower, as low as $100,000. Although once the loan amount need goes over 1 million, it does get tougher for us, but we are able to work through with external lenders or your funders to accommodate your needs as much as possible. And loan duration, typically up to 5 years, with rates currently in the 5 to 6.5% range with a 1% closing fee. And that said, and this is important, we don't approach these as one size fits all. We work very closely with each nonprofit to structure something that aligns with your funding sources and your project timeline and your overall financial position. So whether that's having interest-only periods, an amortizing loan, or having a customized repayment timing that aligns with your grant payments, we try to be as flexible and collaborative as possible. And moving on to the next slide. So to make this a bit more concrete, I wanted to share a recent example of a loan we closed to a group called Triskelion Arts based in Brooklyn. As a quick intro, Trisk provides space for dancers to help develop and showcase their work. And Trisk had an opportunity to purchase their existing space in Greenpoint, which was a major milestone for the organization. And they had already secured the full budget for the purchase of their building by raising a mix of private and public dollars. However, the city capital grants that they secured were expected to arrive on a reimbursement basis. So the challenge here wasn't whether they had the full funding lined up, it was the timing of the funds. So Sea Change provided a 1 million bridge loan, which allowed Trisk to move forward with the purchase and complete it on schedule. And as their grant funds come in from the city, they will be using those funds to repay the loan. And as final thoughts, at the end of the day, our goal is really to be a thoughtful and flexible nonprofit partner to you and not just a lender, and help you move forward with your projects that are critical to your mission. And we understand that every nonprofit situation is different. So we're always happy to have early stage conversations with you as well, even as your project is still taking shape. Yeah, so thanks again. I'd love to hear more about what you're working on and answer any questions that you might have. And I'll pass it back to you.
Thanks so much, Minji. And again, I know this is a lot of information to take in, so as questions are occurring to you, please don't hesitate to put them in the Q&A. Next up, we have Anna Campbell from the Howard Gilman Foundation.
Thanks, Anne. Hi, everybody. I'm Anna from the Gilman Foundation. I am the Senior Director of Programs and Planning, and I'm happy to talk to you a little bit about what we do in terms of capital support. As you can see, the Gilman Foundation is a private foundation that funds over $35 million in grants to performing arts organizations in New York City. Primarily, we provide general operating support. That is our first mode of grant making. And for grantees that are in our portfolio, we also work very closely with them on their fiscal health through financial capitalization grants, as well as grants that are supplementary in nature, which includes funding for capital needs in different projects. Next slide, please. So the capital work that we support ranges in type from space renovations, acquisitions, or new buildings, equipment and technology, or building reserves for ongoing maintenance of space. And that's part of the capitalization work that we concentrate on. Here, I've listed some details about the various capital grants. Space grants, we try to fashion around things other funders and other pieces of the financial picture don't support. So we know that with city financing, a lot of times the early soft costs are not part of that funding. So we try to invest there. We try to make sure that our grantees have project managers or owners reps to help manage the projects. And we also look at contingency funding, which is always important when, space grants or space projects don't ending up on time. They take a little bit longer often. Equipment grants can be for large or small equipment needs. During COVID, we made a lot of grants for video and media equipment while everybody was transitioning to online work. We've also funded HVAC systems for larger buildings that needed a replacement there. And then in terms of building reserves, we really focus on making sure grantees are set up for long-term maintenance of these capital projects. And that involves having cash on hand to address urgent or unexpected needs. Thank you. So these are some examples of different types of projects that we've supported in the past. In terms of acquisition, Wild Project in Manhattan was offered an opportunity to purchase their space, and we were able to help them do that by putting down some cash for the down payment so they could reduce their future mortgage payments. With National Black Theater, they are in the midst of a brand new building that is currently developing on 125th Street. And we've been able to help them with their soft costs in the very, very beginning and close out the construction budget at the very, very end. With the Center for Performance Research in Brooklyn, we've helped them with a HVAC replacement, which is always helpful, especially when you're working with movement-based artists. And in Flushing Town Hall in Queens, we have set up a building reserve fund for them so they can continue to maintain their facility there. And those are just 4 examples. We have many more. I know Minji talked about Triskelion. We also helped out with the down payment for that organization. So we're happy to talk more about other opportunities as they come up. I'll pass it back to you, Anne.
Thanks so much, Anna. Next up, we have Clovis Thorn from Amalgamated.
Yes, thanks. And my name's Clovis Thorn. I'm a commercial banker at Amalgamated Bank. And before I came to the bank, I worked in New York City nonprofit for 23 years, including at a settlement house that received significant city funding and understand how that system works. And in fact, in my time at Grand Street Settlement, we were doing a capital project and had a loan from a nonprofit finance fund, which that's how I met Inez. And that's something you all should know too, is that the folks on this call, we oftentimes talk to each other because each type of lender kind of has a different lane or can meet needs in different ways. And so we're happy to share information back and forth to figure out how best to suit the needs of your project. So Amalgamated Bank has been in New York for 103 years. We were founded by the Amalgamated Clothing Workers Union of America, a union of low-wage immigrant workers who couldn't get banked, so they decided to start their own bank. Since then, we are very much still involved in with the labor movement, but we have expanded into serving nonprofits across the country, B corporations, sustainability organizations. And nonprofit is one of our biggest sectors that we serve, and we do a lot of lending in this space. So I might repeat a couple things that have already been said by our colleagues, but I think it's good to have that kind of repetition so that we can all gather some learnings here. So let's start by grounding ourselves in what working capital means. It's about access to cash when you need it, and it's not about the revenue itself, but how and when that revenue turns into cash. That timing gap is what creates the need for borrowing. And so I'll be speaking of for banks as a category, not just about my bank, but about commercial banks as a category, and when it would make sense for you to approach a bank about any kind of lending. So you'd probably think of banks more for larger projects. At Amalgamated, we can do loans just under our internal policies up to $20 million. And if the loan needed to be bigger than that, as Inez mentioned earlier, we can also go into what's called a syndicated loan or a participation loan where multiple banks will come together to tackle some of those larger projects. So banks typically offer a few common structures, including lines of credit, revolving loans, bridge or term loans, and mortgages, depending on the use of the funds. And some things you need to know is that a bank, when we're evaluating a borrower, we look beyond today's balance. We will want to see clean audits for at least the last 3 years, if you have them, a history of positive cash flows, and confidence in the future revenue sources. A key concept is banks will want to see at least 2 ways out for repayment. What does that mean? And also, this is what often distinguishes commercial bank lending from other sources. Banks are highly regulated. They have inflexible risk policies to ensure they're going to get repaid. And typically, they do that through requiring a combination of collateral and strong cash flows. So a bank will look for some kind of collateral that could be a lien on the building or a lien on the business assets of the organization, and proof that the organization can service the debt through normal operating cash flows. And that's measured as what's known as the debt service coverage ratio. A bank will also often require that a borrower move their operating banking and deposits to that bank. Not always, but that sometimes can be a requirement, or at least an understanding of the lending situation. And, a bank is really going to take a look at the organization, how it's operating, and see that the leadership is strong and has and is strategic. Next slide, please. So let's now narrow this down to those larger loans, the term loans or permanent financing, including a mortgage. So these are long-term loans, oftentimes for several years. and designed for specific projects, not day-to-day operating cash needs. They're typically structured with fixed interest rates and fixed payment schedules, and in some cases, banks may require a principal and interest reserve to reduce risk. And so, from the lender's perspective, this requires more upfront and longer-term diligence. Banks want to see budget projections that cover the full loan term. And one thing you should remember is that in most cases, you're under no obligation to accept the terms that a bank offers you until you've signed a term sheet, at which point you may pay a deposit. So, as Inez mentioned earlier, it's really smart to shop around, compare terms from multiple lenders, and choose what's best and what fits your organization and your project the best. So the key takeaway here is that long-term loans are really about long-range stability and not short-term liquidity needs. The next slide, please. So my final slide is actually an invitation. This is especially good for nonprofits who receive funds from the New York City to get a broad overview of the lending landscape for nonprofits in New York City. This QR code on your screen will lead to an article by a firm called BDO, which is a nonprofit accounting and consulting firm, and I'm sharing it with their permission. It really lays out the borrowing options for nonprofits in New York City. It has some great charts that you can follow to see like, oh, our project qualifies this way. Maybe we should go talk to these people. It actually lists, I think, all the lenders on this call and many others. And I really wish that there was a report like this when I was working in nonprofit, because it is very useful and kind of serving as a guide to how you can put together your finance stack for a project. And with that, I'll turn it back to Anne.
Thank you so much, Clovis. And just a reminder to our audience that we are going to be sharing these presentation decks along with recordings of the videos. So if there are slides that you weren't able to catch, don't worry, we will definitely be sharing this material out. And next up, we have Karina Bucciarelli from Small Business Services to talk about NYC Future Fund.
Hi, everyone. Thank you so much for having me. I'm excited today to talk about NYC Future Fund that was recently announced by the mayor of New York City. If you can go to the next slide, I wanted to give an overview of who we are. Here at the Department of Small Business Services, we help unlock the economic potential and create economic security for all New Yorkers. So we have programming around workforce, neighborhoods, and businesses, and I'll be focusing in on our financing assistance services. If you can go to the next slide, please. So we have a number of services available. This is available only to small for-profit businesses here in New York City, but we are able to provide technical assistance to you as you complete loan and grant applications for your business. And today I'll be focusing in on specifically the New York City Future Fund. If you can go to the next slide, I'll give an overview briefly of what the Future Fund is. So New York City Future Fund is a revenue-based loan, and that means that your repayments will tie into your monthly revenues. We did this to have built-in flexibility so your business can better manage the ups and downs that come with your cash flow changes, particularly, folks on this call who have creative businesses or maybe have seasonality to the type of work that you do, that could be a really great fit. So existing small businesses, this is only available to for-profit entities, but your minimum qualifications that you need to meet for this loan fund is that you have at least 12 months of revenue, at least 1 year of filed tax returns, and you're making at least $50,000 in annual revenue. The funds can be used for working capital, inventory, marketing, new hires, materials, small equipment, and as well as refinancing existing debt that you have. So a bit more details on the terms of this loan product. So this product ranges from $25,000 to $500,000. Importantly here, the term is up to 5 years, but because this is tied to your revenue, you'll be paying it back based on your revenue month over month, but it will not go over 5-year term. The interest rate for this product is 7.5%. The principal payment for your loan, so this is your monthly payment, will be adjusted based on your revenue, and it will be set at a percentage of your monthly revenue. Importantly, we have a revenue threshold. So if your business does not pass that monthly revenue threshold, so maybe you had a really slow month and one of your contracts didn't pay yet, you wouldn't make a payment on the principal. You would only pay interest that month. So we've seen this loan be really successful for businesses that maybe are a contract-based type of business. And the next slide just details some of the other benefits of this program, including meeting with a technical assistance provider once you become a borrower to be able to talk about things like your business monthly performance, your cash flow analysis, as well as work on financial projections together. This is how you apply. If you go to nyc.gov/future fund, these 4 steps will be listed out there, which you can review and begin the pre-application process. And I also recommend, if this product doesn't feel like the right fit, but you are a for-profit entity that is looking for financing, navigating over to nycfundsfinder.com to see additional options through that we recommend here at SBS. Thank you so much. I'll pass it back to you, Anne.
Thanks so much, Karina. We are going to pull down the slideshow now and have all of the panelists join us for a Q&A. And we can kick it off with this question. How should organizations, whether they're nonprofits or small businesses, really think about financing for infrastructure versus programmatic growth? And maybe I would start with Sea Change on that one.
Hey, Dan. I'm not sure if I understood the question correctly, but if you're thinking about planning for capital projects versus operational expansions or day-to-day financing needs, I do think it's very important to understand the particular sources of funding that you have secured for those capital projects. And then also one thing that we always mention to potential borrowers and nonprofits that come to us is beyond the post-acquisition or renovation period, have you thought about the financing needs that will arise once you've acquired the property? And I think that's something that a lot of folks kind of, don't pay as much importance to it or forget to think about it because you're so focused on just getting through that first hurdle of acquiring your space or renovating. But, we speak with a lot of folks that, have, once they've acquired the property, are running into issues with maintaining the space properly because, for instance, the property could be dilapidated and requires a lot of renovation, and that could result in another big financing need that you hadn't anticipated for. So I think it's important to think about sort of not just that first step of completing your capital project, but what happens beyond, and do you think you have the balance sheet and sort of the funding support and whatnot, or additional revenues to support that space beyond that project itself.
Thank you. We have another question, somewhat related, I think. From the perspective of the lender, how is risk calculated, especially for longer-term loans? Many cultural nonprofits will have higher yearly expenses than incoming revenue unless you include public grants from organizations like DCLA or others. And that was initially directed to Inez and Clovis, but I invite anyone else on the panel to join in as well.
I can take a crack at that question. As lenders, our main concern is that the borrower is able to repay the loan. Sometimes some borrowers think that if they bring a strong collateral to the loan, that would remediate or mitigate that risk. But in general, what we need to ascertain is that whatever the repayment source is, it will be coming in time and in a sufficient amount to repay the loan or to cover debt service payments, which include principal and interest, as well as any other fees incurred in closing this loan. The rule of thumb for lenders is to get to a what we call debt service coverage ratio In our case, NFF's case, we try to see that the repayment capacity of the borrower is aligned with a 1.2 times debt service coverage ratio, which means that their revenues are able to cover debt service in such an amount that they can cover operating expenses plus a little bit left for debt service. I mentioned collateral. In this type of project, capital projects, we normally try to secure loans with collateral. And one risk may come from the fact that the collateral is not able to cover 100% of the loan. We call that loan to value ratio, and that ratio gives us a good sense of whether the borrower will be able to repay the loan in case when the initial repayment source, which is their cash flow, or the grant that is being breached, doesn't crystallize. So we want to see a strong collateral, and sometimes loans are under collateralized in cases where the collateral doesn't match the amount of the loan, and that will be another risk involved in the transaction. Clovis, you want to share some wisdom on the banking side?
That was great, Inez. But I'll add, I see Baz's question in the chat. I think implicit in that question is that just out of like operating revenues from ticket sales or whatever, the arts groups are often operating in a deficit. So when you add in the public grants from DCLA or others, that's how you get to your operating or your cash flow surpluses over time. And so, yes, those sources of funding, those future sources of funding, those grants can definitely be considered in the underwriting. Just know that the lender is going to verify a dozen different ways that those grants. We can't really work off of, oh, we think we're going to get some funds from the city council, or our development director told us they have a great stretch funding goal next year that we think we're going to hit. We really do need to see that you have contracts in place, that you have grant agreements in place, that those multi-year grant agreements that funder, if they've funded you before for many years, that's a big plus mark in the plus category. So we can use those in the underwriting. We will just work to verify that those grants are going to be paid in the future.
I see a business question, but there's another question that's sort of related to what we're talking about right now. So I'm going to go that one first. For nonprofits considering a capital project, is there a magic percentage for funding secured versus loans before starting? Obviously, 100% funded is what everyone wants, but what ratio are successful projects starting with? I see you nodding, Minji. Do you have thoughts on that one?
I think it's a great question, and I'm a little careful about saying a particular number because it's, at least from the things that we see, it's quite case by case. But I would say that if you're maybe 80% to the mark that you need to get to, just have the first conversation with like whether it's Seed Change or another lender, just to have that discussion about what what else you will need to show in order to get there, and like have a full application, because that will be very helpful. And sometimes, when you're able to show to a grant maker or your existing funder that you have an interest from another lender for a potential capital financing loan, that can sometimes unlock additional grant opportunities, because it could signal that, okay, like I have a solid project and I could get there, and there's a lender that would be willing to look at it if I were able to raise an additional X number of dollars. So that could be a more compelling request to your existing funder. So I would say don't shy away from the early stage conversations, because you'll definitely learn something and will help you get to the 100% or the 90% or wherever you want to get to.
Thank you. So there is a question for the future fund. If there are exceptions to the 1 year of income, is there a carve out for startups?
Yeah, thanks for your question. I also typed out an answer. Hopefully it's visible, but there's not an exception for startups. That being said, SBS does have a number of resources available to startup businesses at nycfundsfinder.com. You can review additional loans and grants available through our partner CDFIs, as well as schedule a one-on-one meeting with a finance account manager to review your specific business needs, and they can make a referral to the right loan product for you.
Another question from small business. Is there a service or program to allow an LLC to receive funding for a nonprofit project?
I'm not sure exactly. Maybe more information on this question could help, but SBS does not provide services to nonprofits, so it would really be funding and resources available to for-profit entities.
And then in the case, for our nonprofit funders, is that because there are a number of arts organizations that operate through fiscal sponsors, are there situations where fiscally sponsored projects can access capital funding?
At SeaChange, we do consider loans to fiscally sponsored programs on a case-by-case basis. They typically do, the conversation does get a bit longer because we obviously have more questions about, for instance, a nonprofit has a board of directors. What does that look like for this fiscally sponsored program? And then financials for some fiscal sponsored projects, they don't have the particular financials like a clean balance sheet or income statement set out for them. So sometimes it takes some time for you to get that information from your sponsor. But that said, if your program is nonprofit oriented and you sort of are able to show for that, we still do welcome those conversations.
Just to add on to Minji, so how I would look at an organization that's under a fiscal sponsor, generally, we would actually have the conversation with the fiscal agent, and more or less it would be the agent that would take out or apply for the loan on behalf of their fiscal sponsor, the sub. That's how our approach usually goes. But it also, we talk with the group to see where they are, what's the relationship, what's the history of that award or contract. But typically the loan is usually to the fiscal agent.
Thank you. There's a question regarding, and I would imagine they're looking to see if there's a standard timeline for receiving funds when a loan is requested.
I can share the timeline for NFF, which is something that I included in one of my slides. Basically, we recommend clients start looking to speak with lenders and sort of get a good sense of what the offering is out there for the type of project that they have in mind around 6 months before actually needing the funds, because I can only speak for NFF, but the timeline for us between the moment we receive initial due diligence, which is after the initial conversation with the client, we request documents that include financials, audited statements, budget, project budget, some organizational information, some information about programs and community served. From the moment we receive this initial package, and we can make the high-level assessment of the feasibility and viability of the loan to closing, our standard average time is 12 to 14 weeks, which basically is 3 to 4 months.
Andrew, do you want to weigh in?
So that's a hard one because it varies for us. It's still, it's not like our operating loan, which is usually, I would say, 3 to 5 business days. Our capital tends to be, even though it's definitely much shorter than banks. I would say it averages 3 weeks, possibly. Typically with our capital loans, it's usually against a certain receivable still. And it's usually where it's going through DCL, it's a pass through DCLA. It could be the award could be going through EDC or DCAS or DDC. One of the main things that has to happen is that you have to have your certificate to proceed in place for us. So that's more or less the initial driver that can make the conversation go faster. Um, so if they have that, things go much quicker. But I would say 3 weeks is the average.
I'll chime in too. On the bank side, we're very similar to NFF in that it would be at least 3 months, depending on the complexity and size of the loan, perhaps 3 to 4 months. I think also in your question, it seemed there was like, when will the cash be available? For these kinds of loans, the cash is available upon closing. So it's like buying a house with a mortgage. As soon as you close on the house, you get the keys. The cash would be available same day as closing.
Thank you. That's very helpful. And then there's one last question. So Shea Bushwick is undertaking a new capital project. It's their third small one. It's an ADA renovation, which includes a passenger elevator, and it will service from the street level to the venue level. They would love advice on this type of capital project. So if anyone has some advice to give this group, that would be very helpful. I think the idea is, how would they go about securing either capital financing or a loan for this project, this particular type of project?
I can start to take a crack. I think, as Inez mentioned in one of her slides before, I think having a great understanding of your sources and uses, which is basically where are the sources of funding for your project and how will they be used, given it's a renovation. So, what are some of the soft costs and how much will you need for that? How much will you need for hard costs, which is just, cost used for the construction itself. So having a good understanding of that, and probably you will have had a conversation or have already hired an architect or the general contractor who will be doing the work. So once you've done sort of that homework and pre-work, and then you have a conversation with the lender, that conversation will be much smoother. But as you're kind of exploring this project, we're happy to speak with you and kind of give you some more specific guidance. It's helpful.
So we are at the close of our panel, but before we sign off with general announcements, just wondering if the panel would like to share any last words of wisdom for the group.
I mean, I would say always, as Minji just stated, I would say just you can reach out to any one of us at any time. My office, my line is open for anyone just wanting to ideate. I know you, Shay Bushwick. You can always give me a call. But I think if you reach out to any one of us, we each have intellect in each of our sectors, and we're willing to help you in any aspect of your project or future project down the line.
Yeah, I'll echo that. I think just have a plan in place. The more you can have plans, details, budgets in place, and then start talking to people. I email with Andrew, Minji, and Inez all the time about different deals that I can't do this. Could you take a look at this? All that kind of thing. So, we're going to try to do what's best for you and your organization. So don't be afraid to start that conversation. And the more information you have about the project, the better.
Actually, Clovis, since you're speaking, there was a question, because yes, a lot of the resources that we shared today tend to be for not nonprofit. but I know that Amalgamated also has some small business lending that might not be your area, but if you could speak a little bit to that so that we can just share that information here.
Yeah, it's not my area, but the question is right. By the way, banks treat nonprofits like businesses. We really do. I call them more like social benefit businesses, and we need to see that. We need to see that nonprofits are operating like a business and succeeding and sustainable over time like a business. So yes, almost everything I talked about in my slides would apply to business, for-profit businesses also.
Thank you. Anna, did you want to share?
Yeah, I was just going to echo some of the things that have just been said. I think the capital projects that I've worked on with grantees have involved so many different kinds of funding, so many different pieces of different pies. And so the folks on this call we all do slightly different things. And it might take all of us, maybe not all of us, but a lot of different resources to make something come to life. And so I think Minji was saying earlier, it's never too early to start thinking about who those resources are, who those people are, just try to piece together the right team to make it happen. So I hope that is helpful for everybody who's thinking about something for the future.
Absolutely. I want to thank all of you for joining this panel and for being wonderful partners to Create in Place. We are often referring people to you. And to the question about small businesses, again, the Future Fund is just one of the many, many products and services that SBS has to offer. So I encourage you to get in touch with Karina. We have also included in the chat links to next week's resource fair, legal resource fair, the link to the NYC Create in Place webinar archive, as well as links to sign up for the newsletter. And if you are having any space issues that you'd like to sort of explore, address, you can certainly reach out to NYC Create in Place. We welcome the opportunity to serve you. And again, thank you so much to our panelists. Really appreciate your time and the ways that each of you are supporting the creative sector. So thank you, everyone.